Hello, welcome to another episode of Decentralounge, brought to you by GlobalStake, your institutional, truly decentralized, self-owned and managed SOC 2 Type 2 compliant bare metal staking service provider. Today's episode, we're thrilled to have Michael Rey, the innovative founder of Liquidity Slicing Protocol, or LSP, and former CEO and co-founder of Cerchia. He is joined by Fang Zhang, the CEO of LSP. Liquid Slicing Protocol is a pioneering advancement in blockchain technology focusing on optimizing liquidity distribution within decentralized finance. Previously, Michael led Cerchia, a Swiss-based headquartered fintech that revolutionized the risk transfer market by directly connecting protection buyers with institutional capital providers on Avalanche C-Chain, successfully raising CHF 1.3 million in funding. Through Cerchia, though Cerchia has since been discontinued, the valuable intellectual property developed there is being integrated into his new ventures. Join us as we explore the impact of these technologies and Michael's vision for transforming financial interactions in the digital age. Michael, Fang, welcome to the show. Looking forward to hearing so much today. Why don't we just start off with your backgrounds and how you got to be interested in the Web3 space overall?
Well, thanks a lot for having us. Maybe I just kick it off very quickly. Yes, my name is Michael, and I started off in TradFi actually for many, many years, been in banks and dealing with all sort of problems there, specifically from a risk management perspective, which I felt, well, there must be better solutions to this. And especially when it comes to derivatives trading, all sort of settlement of financial derivatives, all these intermediaries and all these risks that come from all these processes, which are just very outdated and have been clunky for the longest time, very inefficient. So it's only about 4 years ago when I sat together with my former co-founder of a company, Cerchia, that we were plotting on how to solve these type of problems. How can we get better derivatives out there and use the technology that actually supports this? And we never thought of building a blockchain company, but it kind of fell into our laps that this is the technology that can enable this. And once we kind of grasped this vision, we couldn't let it go anymore. So well, we have to build this on blockchain, and we started plumbing and got everything ready and got funded, and there was a great journey. A lot of lessons learned. Startup is never easy. As you mentioned before, we had to discontinue the company because, our use case, a typical real-world asset type use case, was probably a bit too early. We were funded just when we ran into the former crypto winter, 2022. And by the time, really we get back into the bull run with a lot of hype around RWA cases and insurance and reinsurance, securitization and so forth. We were running out of money. We didn't make enough money, so we moved on, but preserved the IP for sure. So this is important because we see now a lot of interest coming through in this space, especially. I will talk more about LSP later, but Fang, why don't you quickly tell us a bit more about your background?
Yeah, thanks. Thank you, Funky, for having us today, and Jordan, and thank you so much. So my name is Fang. So my journey with a blockchain is a little bit unconventional. So I was trained as an architect, pretty much driven by a family full of architects and civil engineers. I felt like I had no choice but have to pursue the path of being an architect. But later on, I realized I'm really interested in finance. I like numbers, I like financial modeling. So eventually I transitioned into finance and banking as well. So I had about 13 years experience in banking and the capital markets, including 6+ years in Wells Fargo corporate and investment banking, doing agency CMBS. So I feel like probably because of my background, so I would think I'm very naturally a very curious person. So I love to kind of explore new ideas, new concepts. So I started like realize a blockchain that's probably back to 2018. So I went to a coding school in New York City, and then they were talking about blockchain, that kind of stuff. So it's very, very interesting to me because it's kind of like a new concept. So they're talking about like, you know, the distributed ledger technology, you know, the open ledger, immutable transparency, all that kind of stuff is just so like new to me and also very, very interesting. So since 2018, I'm still working in banking, and but you know, apart from my full-time job, I started doing something on the side, you know, including being Centrifuge DAO Credit Group's founding member, and that's kind of like lead my, you know, path, including you know, working with Michael. Michael and I, we started working on our stable coin project, and then later, you know, developed into LSP. So yeah, that's kind of like my journey. It's really kind of like a very interesting, a lot of like unexpected turns, but so far so good.
It's really interesting backgrounds and just diverse. I'm kind of curious to hear how the combination of these two has led to LSP. So I guess why don't we start unpacking LSP a little bit and talk about what liquid slicing protocol is, how it works, and maybe some of the key features and differentiators from other products that are out there in the DeFi world.
Maybe I kick that off, and Fang, you can then certainly fill in much more details. And that's how we also work together. Fang and I have been working always in this space of real world assets, been fascinated. How can we bridge traditional finance and DeFi in a better way and solve problems for traditional finance? And ultimately, working on different projects, we also came across this idea of what we believe is closest to internet equity. We all know internet money, which is cryptocurrencies, which has been traded, but these currencies are idling around, right? They are not creating any cash flow. They're not creating dividends or additional rewards. So I think staking over the last couple of years, ever since proof of stake networks have caught on, have been very successful, and ultimately also led to the concept of probably internet bonds, where you have liquid staking tokens, getting rewards and creating that liquidity, almost like a bond. And what we now with internet equity frame is effectively the tokenization of the rewards of the validator stake. The validator stake and proof of stake networks are very attractive pieces of rewards, because not only are rewards for staking collected for the validation of transactions, but also the commissions on the rest of the stake, on the entire delegated stake. So that brings the APR on such a unit, on such a token, much higher than typically you would see on a delegated stake token. And that's kind of the overall framing and context of this. We saw since launch a lot of traction on this. I think it's really hitting a need from different angles, because really this product is not only useful as an investment because it's higher APR, it's something I can explain to institutional investors looking for staking assets, creating more cash flow. That's a bit the rundown, but Fang, please tell us more.
Yeah, I feel like you kind of like sum up pretty well. So I mean, I don't know if there are anything I can add on, but basically, you know, if we look at the staking market, I think Jordan and Funky, you are the expert in the staking space, so you know probably much better than me, you know. But in general, my perspective is the staking space. I feel like there's so many projects out there already, but just based on my personal observation, seems they're more focused on the delegated staking, right? From Lido, from Engineer, even though right now Engineer, they're trying to create different products, right? They have a AVS, or kind of like a DA that can different products, but still kind of like heavily focused all around the so-called delegated staking. But from LSP's perspective, is exactly like Michael mentioned, that we're focusing on the equity part of internet money, which is the validator nodes. So what we do is like we're basically using smart contract. That's one of our two very unique technical features to fractionalize, tokenize those validator nodes rewards. And then from the end user's perspective, from investors' perspective, they can freely trade. Either you're a retail investor or you're institutional investor. I mean, that's kind of like our focus, right? From Michael and my perspective, we're focusing on not only creating a marketplace for validator nodes to retail investors, we're also creating something like international institutional grade. And that's why we are creating so-called brokerage service. So we're providing some kind of like off-chain, off marketplace, doing something like a block trade, that kind of stuff. We have a term sheet, we can tailor-made, the term sheet, the portfolio for institutional investors. So that's kind of like our strategy. So we're trying to be not only focused on retail and also in the institutional. So that way can really, combine our background in TradFi and DeFi. So that's kind of like, the whole, the concept. So I mentioned that smart contract that we're using to tokenize the validator nodes. Another very, I would say, unique so far, like technical feature, because technology develops so quickly, so someone can catch up very quickly. So that's why I'm saying so far. We call it Omni Verify layer. So basically, we understand that different blockchain had, the different wallets built on different blockchains. Sometimes it's really frustrating when you're trying to trade. You have to switch wallet from one to the other. So it's really annoying. So we built a so-called Omni Verify layer. So it's kind of like, you can consider that's a bridge, but you won't see anything. So all those communications between different, protocols, or, in the blockchain, our protocol, or, LSP platform has been, solved within this layer. So that's kind of like unique technical feature from our perspective. But like I mentioned that, technology develops like so quickly every day. So maybe there are some like competitors out there already. They're building something probably better than us. That's why we need to constantly, updating our products, upgrading our technology. Yeah.
That's interesting. So I'm curious, it's a unique DeFi product that's now been put out in the market via LSP. What are some of the ecosystem partners that you guys have that you're working with?
Michael, do you want to start it?
You go ahead. You go ahead.
Yeah. So so LSP launched actually in mid of July, which is July 17th, right? So initially we only have a Manta. Manta, right? Which is okay. So and then we also has agreement with Aleo, but Aleo's midnight launch got postponed from mid of August until September 18th. So currently we have Manta and Aleo. So our community are very loyal. They really love Manta and they really love Aleo. They're trading, constantly, right? And that's why our transaction volume since mid of July until now is about 26 million already. That's pretty decent for a start. And then, in addition to Manta and Aleo, we are also going to onboard Zilliqa. It's a little bit like a well-established L1 blockchain. But they're also like upgrading, so they're moving from pure POW to POS. So Zilliqa 2.0 is going to be launched. I believe their testnet is going to be out within like 2 weeks. So we have been working with Zilliqa team tirelessly, testing validator nodes, and make sure once they're testnet out and then mainnet out, and then we can put the nodes right away to our marketplace. But we have been working. There's so many work behind the curtain right now. So Cerchia will be on board by end of December, and then we're also talking with Arbiter, and then there's some other stuff. I'm personally also trying to reach out to Manite and Morph and also Sui. So, but there's there's a lot of work. It's a very early stage. I'm not trying to give them any pressure, saying, okay, you're gonna to do this, but that's kind of something we're working. Yeah, it's kind of like a WIP working in progress. Yeah. But our goal is trying to add probably 10 more protocols, probably next year, probably between Q1 to Q2. Yeah.
So we're constantly onboarding new protocols. That's kind of the supply side, the product side. On the other end, this is distributed currently mostly to retail, a thriving community, mostly based in China. And they love the product because, they can earn probably 2 to 3 times better APR than just staking the token directly. And here we are now also in final discussions with investors in a DeFi space, especially. They can put together pools or vaults to invest into this product. They prefer a portfolio-based approach, of course, because they can mitigate some of the individual protocol risks and slashing risk, of course. But that's why also we need to really onboard more names and more protocols to build proper portfolios.
So I have a follow-up question based on that, and just hearing all the protocol growth that you guys are experiencing and the different chains you're working with, and just getting back to the idea of how you're effectively tokenizing the yield that the validator nodes earn. So how does that work? Maybe we can double click on that and expand on it. Is it something where you go to the validator node operators and basically say hey, would you sacrifice X amount of your commissions or yield to be sold as a tokenized product? I'm assuming they get something on the back end to make up for their commissions, and then you're putting it out there. And I guess my second kind of follow-on question would be, because you just mentioned, Michael, how this is done in a portfolio manner. Are all of the yields then aggregated into a single product where they're just buying, say, an LSP token that is an aggregate all of those various yields, those various staking yields on each of these given protocols?
So there are 2 models to actually onboard a node and tokenize the validator rewards. The first one is actually we do it ourselves. We provide validation as a service. So we can just seed a node and we can process into the validation for all these different protocols ourselves. That, of course, we will also charge a commission for doing that work. But then all those rewards are, again, verified, that come through, are verified and passed on through a token to the protocol that we have to the, what we call node slice, is again the tokenized version of these validator nodes. So it's a bit then becoming a bit like an annuity that will pay these rewards over time. That's the first model. The second model is if somebody has a node and just wants to tokenize those validators, maybe to raise some funds, because also if you are a validator, you might, you have to put up a bond. You have to put up, let's say on Ethereum, you need to put up 39 Ether just to be a validator, right? That can be costly, increasingly costly now in the bull run. So you can take out a bit of liquidity for that bond that you have to put up, and doing so by securitizing those rewards. Or in that model, you will still get paid that commission that you earn for the validation work, but of course the rewards themselves are passed on. So that's the second part. When it then comes to the investor, what do they buy, right? They buy, as I mentioned, a token that can be a bit like an annuity, which is the future rewards for that period of time that we are locking up all these tokens. And here, this is specific to one protocol, for example. I mentioned, Fang mentioned we have Manta yielding 28%. Rather than the 15 or so. So you have the you have the 28% that are being yielded, and these rewards are passed through to the wallets over time. If we now want to invest into a portfolio, we need to again have another wrapper of such tokens. So we have a token that now receives these individual rewards from node slices and wraps that as a portfolio. So the other way that we are building this is now with vaults in DeFi. So we have a DeFi protocol out there that's already just providing liquidity into a vault that then buys several individual such node slices for different protocols. And you build a portfolio right there in the vault.
Very interesting. I also noticed on your website you guys have another product that you have coming live soon called pre-trading to help people discover alphas a little bit earlier. Can you guys kind of talk about or at least allude to what you're building?
Yeah, I can take on this. So basically, like I mentioned, we constantly updating our product and our website. This website actually just came out. So when you click the website, you probably see some part of a function doesn't work properly because we're still like constantly improving that. So the so-called pre-trade, because before we only have validator and delegate staking, right? So right now we are trying to add one more called the pre-trading, pre-market. It's kind of like before the token go to TGE. It's kind of in between that area. So basically, we're really trying to leverage our relationship with protocols to get to the ground zero, so we can get the best discount, and then we can kind of like distribute that back to the users. So I also want to add on a little bit to Michael saying about why we have a boosted APR for validator nodes, right? Basically, the reason why is because in addition to the normal rewards, we also get commission, and also we leverage our relationship with the different protocols and to have some kind of a discount. So all of those like rewards, commission, and discount will be kind of like distributed to the investors. So for the platform, we are now really keep too much only in the transaction fees. So that's kind of like, that's why we have been building a very loyal community, because they understand why we can provide like a much higher APR. For example, Manta 14% for delegate staking, 28% validator. Aleo same at 13% delegated and 28% validators. The things like majority of LST, right, liquidity staking token or restaking protocol, if there comes from Ether, if you look at Ether's reward, it's about probably 2.8 to 3.5%. That's from Ether, right? But if you strip off, the middleman and then inflation, the very thin like margin left to the end user or investors. So that's why I feel like Michael and I, we think like we really have kind of like a niche market, and we really can not only like create additional yield for the end user investors, and also helping protocols to really help them to decentralize their whole protocol, and also provide some additional liquidity to the protocol foundations or early investors. They have token locked in and they don't want to dump their tokens, and then they couldn't to the market to impact the price of the market price.
I just want to quickly add to that as well, right? What is the benefit here, and what's the value add, right? You have the protocols and the foundations and the founding teams. Many protocols, they have or early investors, they have purchased tokens early before they are floated, before they are somewhere listed on an exchange. So they, first of all, very illiquid. Sometimes they've invested, so they just idle around first and foremost. They cannot be used to do anything else. And with our mechanism, by actually using those still illiquid tokens and lock them up over a certain period of time, let's say a year or two, you can seed a node, and you make them productive, because you lock them up as delegated stake or as a validated stake, you can now retrieve rewards from that from the network. At the same time, you do good because you create more nodes, right? That's especially in inception stage very important to distribute, diversify your network. So suddenly you have a productive asset, and that pays you rewards for these otherwise idling tokens. Additionally, you can almost raise money in OTC market by now tokenizing, by issuing this and creating this node slice, by creating this internet equity. You can sell that on to investors outside of exchange, outside of the typical market. So it's another type of fundraising avenue as well. And because it's possible to do that, you can think of it a bit like a block trade that Fang mentioned. What you see in equity markets, you can accept a bit of a discount on that entire stake overall, the valuation, which also then means, again, the APR that somebody enjoys investing into this is again multiplied, has another lever higher up, right? And that's why we can really offer very attractive APRs to end investors.
Interesting, fascinating. Well, the liquid slicing protocol is different, definitely a unique twist on what we currently see in the market. And we love having founders such as yourselves on the podcast to be able to talk about these unique ways that people are building in the ecosystem. Because more often than not, we hear institutions tell us, even our customers, everything's still the same. When is somebody going to build something different? So fascinating to have you on. For those that are listening, what's the best place that people can reach out to you and your protocol, interact with you as a user, or even somebody who's wanting to be a partner?
Twitter, LinkedIn, I'm on Twitter all the time, I follow you, I follow Funky. So Twitter or, LinkedIn or awesome. My email, whatever they want. It's at LSP. Yeah.
We'll make sure to have the socials linked below. Anybody that's listening right now, everything's in the description, as well as the actual liquid slicing protocol app is linked, as well as the website. Please reach out to Michael and Fang and just pick their brains, and let's help this protocol continue to expand and grow. But really appreciate you guys coming on today.
Thank you so much.
Thank you very much. Excellent.
Thanks so much, Have a great day.
Thanks, everyone.
You too.